growing up poor, I'm very, very frugal. I mean, I remember in college going to the ATM and withdrawing $20 because that was the minimum. And I was wondering, why couldn't the ATM just give me $10? $20 was so much. And so now, not to even have to think about money is something I can't, like, not to think about spending, it doesn't matter how much things cost now. I can't do that. So I'm still very, very, very frugal. And I'm always looking for deals. I'll look for coupons.
You're listening to the Millionaires Unveiled podcast, where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their current portfolio allocation. Now to your hosts, Clark Sheffield and Jace Mattinson.
Okay, welcome back. 250, Jace, episode 250 Millionaires Unveiled podcast. Thanks for listening, everybody. Jace, what's going on?
Hey, man, I am pumped. When we started this thing, I don't know that we ever thought to the 250 episode, but here we are, 5 years in, interviewing all these millionaires. It's been a tremendous journey, that's for sure. Crazy. Midsummer here, heating up. I love it, man.
Yeah, and we got a fun interview to celebrate 250. Jennifer with a net worth of $100 million. So
yeah,
we've had our 100th episode was $100 million. Is that correct? I'm saying
yep,
that right.
Yep,
right?
That's correct.
And then we've had somebody a little bit higher, and then here we go again, 250, another $100 million. So fun to just hear a totally different perspective. She grew up poor, has the majority in one stock, but just a great story overall, and just a great lady, and fun to connect with her, and a fun story overall. Just as a quick recap, last week we had Zach, net worth about 6.5, and he is primarily in real estate between single family homes, duplexes, some multifamily, a lot that he personally owns, and then some syndicated as well. So, Jace, one topic that we haven't spoken about much on the podcast when we've talked about introductions or even with people is lotteries, which is obviously a little bit, different of a topic. But when, you hear people talking about it now that this Mega Millions is at $1 billion now. So some fun facts. I just looked up a few articles here. It says the already giant 810 million Mega Millions lottery jackpot ballooned to 1.02 billion after no one matched all six numbers Tuesday night. So this is last week or a few days ago now. This is coming out Monday. And it says you can take a 1.02 billion option paid annually over 30 years, or you can choose the cash option, which is estimated at 602 million. Your chance of winning is 1 in 303 million. Tickets cost $2 each, are sold in 45 different states. So pretty wild, Jace. You feeling lucky? 1 in 302 million is your chances.
Dude, I might go buy one, Check this out. A couple bucks, throw into the pot just for kicks and giggles.
That's how it gets higher. I don't think I've ever bought a lottery ticket.
I never have either, man.
Yeah.
But it is wild. And I saw a couple articles too about some companies. I think CEO of Raising Cane's or founder of Raising Cane's maybe pitched in and bought a ticket essentially for every single one of it, or equivalent of like one per employee, and said that if any of those tickets win, then basically they'll share the money with the whole company. And I think there's a couple other companies out there that have done the same. So it's kind of crazy. Given I mean, I don't really pay attention to the lottery that much or any gambling in general, same. But I mean, it's a big business for one, and two, obviously somebody's going to come down with that pay, whether it's the payments over 30 years or taking a lump sum of $600 million. It's wild.
Yeah, it says this is the third biggest lottery of all time. So estimated to get up to 1.1 by the time I guess the next drawing. And then the biggest was 1.6 in January of 16 and 1.5 in October of 18. This is per CNBC. It says there's a required, a mandatory 24% federal tax withholding that would reduce your winnings by a cool $155.6 million. So, unfortunately, you're not walking away with as much as you thought.
Yeah, and you know who's going to be there too. Every family member, every financial advisor, they'll be knocking at the door too. So you're probably going to end up paying a few people along the way too to either help you structure for the future and or a few other things. So I'm sure there's some fees in there as well that aren't publicized in the media. Granted, everybody's going to do something different with it, but what'd be interesting to look up too is kind of the results of lottery winners, 10 years or 15 years after, what's happened with their earnings or their wealth or how it was spent or whatever. That'd be kind of something interesting that we may dig into later.
Yeah. I mean, you kind of hear, is it true? I don't know. I mean, you hear that like lottery winners tend to go all pretty broke pretty quickly, but I don't know. Maybe that's been validated. Who knows, right?
Yeah, I have no idea.
Anyway, so interesting topic. We'll see what happens. Maybe Jace will win. I won't win. Anyway.
I'm not buying one. I'm kidding.
If you have a question for us or for any of the millionaires we interview, go to our website, millionairesunveiled.com, hit the tab, Ask a Millionaire, write it in, and we'll talk about it on the show or ask some of our upcoming millionaires the question. So thanks for tuning in to 250th episode. So we should calculate Jay's total net worth. It's going to be well over probably, I don't know what, Jace, 1.5 billion now?
Yeah, probably close to that. It's definitely up there. We need to go look at that again. It's been a couple months, actually several months actually since I've looked at it.
So I just looked up our sheet, Jace, where we kind of keep track of this information and track it. So we're at about a little bit less than we thought, 1.2 billion. That's not everybody that's been launched, but we still have a few in the pipeline of completed interviews that we'll get out. But yeah, total net worth of people that we've interviewed through 250 episodes won just over $1.2 billion. So anyway, pretty interesting stuff. And you start noticing a lot of the same trends. You listen to enough of these episodes, but obviously everybody has a little bit different strategy, a little bit different take on things. There's no one way to do it, right? Yeah. So anyway, thanks for tuning in. And without any further delay, let's jump into today's fabulous interview with Jennifer.
Jennifer, do you want to just give us a little about your background or what you're up to now?
Sure. So I'm the only child of two farmers, and we grew up really poor. I remember my mom would wonder out loud a lot if a check would bounce, and then my dad would fret about it. 7 years ago, we were sleeping on an air mattress, my husband and I, on the second floor of my in-laws' house. And then fast forward now, I'm in my third startup, and we've been doing really well now.
Awesome. Yeah. And we're going to get a little bit more into the details of your story and how you've been able to make it. But what is your net worth today?
Depending on the day, it's around 100 million.
Wow. And how high level, I mean, obviously there's a lot in there. High level, how is that broken up?
At a high level, I would say about 80% of it is in one stock, and then 5 to 10% of it is in my current company. And then we have a smattering across the remaining 10%.
And the majority, that 80% in one stock, is that one stock that is it part of a company that you started, or how is that? How did you get to that point?
Yeah, great question. It's a company that my husband was an early employee of that has since IPO'd.
Wow, that's pretty remarkable. And I'm assuming because of timeline and whatnot, a lot of that is untapped equity at this point. You can't sell anything, or have you just chosen to leave it in there?
It's liquid, but we are very bullish on the company.
Okay. Well, gotcha. So with the money that you've allocated elsewhere, you've got a good chunk in your startup. The rest, what asset classes have you chosen to spread that across?
Yeah, we have about 20% in cash right now for investment opportunities, home remodeling, projects like that. We have about 25% in real estate between our primary residence, rental units that we own, as well as investments between equity and debt. We have about 20% in public equities, and we have about 10% in domestic hedge funds and early stage VCs. We also have 10% in crypto, and the remainder would be in international private equity.
Okay, so quite the broad spectrum there. The money that's in real estate, you mentioned primary residence and investment, are any of those paid off?
No, we have mortgages on the 3 properties we own. We are thinking about actually just paying it off, but the interest rates are so low that we haven't.
And one primary residence and then the others are investments, or do you have second home, third home?
That's a great question. We actually bought a home in Sonoma thinking it might be our second residence. And then we put it on Airbnb just to see what would happen. And it was instantly rented. Before COVID, it was at about 90% occupancy. So we block it off for the, days that we want to go, which has been basically, 0 days in the last 2 years. And it's basically been an Airbnb that we net, $25,000 from cash flow from after mortgage.
And that's $25 a month or a year?
A year.
Okay. So basically you've got a nice place to go visit when you want. It doesn't cost you anything. You get a little extra cash flow on it. And then the other property?
Yeah, I just have to say, one of the benefits of having this Airbnb has been, when you need to donate something for a silent auction, it's really wonderful to donate a stay in a house in Sonoma. It works really well for a silent auction. The other house is a triplex in Napa.
Oh, okay. So you've got some ties to the West Coast there with properties. And did you intentionally buy that as an investment property out there, or was that a different plan turned into investment property?
Yeah, the Napa house is interesting. I bought that 6 years ago, and before then I didn't own anything, any property. And that one I went into with my one of my best friends who had bought a bunch of rental houses, and I wanted to learn from her. And so we bought this house, this triplex, together as a rental property.
And is that cash flow out in California?
Positive, mostly because the Sonoma house did so well on Airbnb that I convinced, my good friend, we should put the middle unit, which we had trouble renting because it's, thin walls in the triplex, to put the middle unit on Airbnb. And it's done really well. And we're mostly cash flow positive because of that middle unit.
Awesome. So as the journey's taken shape here with the increase in net worth and cash and the capital, you got quite the broad spectrum of investments. How did you decide which and how much to allocate to each of these investment classes?
What a good question. And that's actually the reason I started listening to your guys' show, which is we didn't know where to put our money. And so we've just been talking to and listening and reading different people's advice. And the number one piece of advice seems to be diversification. So obviously, we do real estate, and I've learned a lot from your show and the different investors that have come on your show talking about that. At the same time, we wanted to diversify, and so we went into healthcare through some early stage VC fund investing and some public equity investing. We also wanted exposure to cryptocurrency as a new class that's really kind of doesn't follow other markets. And then, of course, the international markets we're interested in because also it doesn't follow domestic markets.
Yeah. So Jennifer, you have those different pieces and then also some operating businesses, right? Laundromat, car wash. I mean, how do you find these opportunities? Jay's just asked about how you come up with your allocation, but how do you even find them in the first place?
Well, on the car wash and laundromat, a family member of mine owned it and was looking to get out because the number of quarters you collect, it's really heavy. And so my family member was aging and was looking for a buyer. And so we came along and had that opportunity to purchase it. But that said, we recently sold it a few months ago, this operating business. We had both the property, so we owned the land and the facilities, as well as the operating business, so OpCo and PropCo. And when we sold it, we listed it on, we went with a broker and listed it on like 6 sites. So if you want to look for opportunities to buy businesses, there are a bunch of sites out there. Buy, Biz, Sell is probably one that is the most popular. And that's who ended up buying our business was an Accenture consultant, and he found it on Buy, Biz, Sell.
Yeah, it gets fun to it's kind of dangerous. You can go down a rabbit hole on that website, right? Just browsing different companies to look at.
No kidding.
So the amazing part, let's go back to the story here a little bit, Jennifer, because I feel like we just kind of skimmed over it. But you mentioned you're an only child, 2 rice farmers. You grew up very poor. You remember your mom talking about bounce checks. Then just, 7 or 8 years ago, you said you're sleeping on an air mattress in your in-laws, and now worth $100 million. I mean, it's an amazing contrast in under 10 years. right? I mean,
really
what's that
is.
like? Does it feel weird? Is it, I mean, tell us about that because I think most people are going to experience that drastic change.
Yeah, it's really surreal. I mean, I remember in college going to the ATM and withdrawing $20 because that was the minimum. And I was wondering why couldn't the ATM just give me $10? $20 was so much. And so now, not to even have to think about money is something I can't, like, not to think about spending, it doesn't matter how much things cost now. I can't do that. So I'm still very, very, very frugal. And I'm always looking for deals. I'll look for coupons and I'll look for, we just had a stay at a really lovely resort, but I got a 50% off on that because I bought it last minute. And I've been telling everyone to get 50% off by buying it last minute.
So the ways they may not change for you.
No, definitely not.
So you still find yourself, I mean, that was going to be one of my questions is, do you still find yourself looking at the price on everything?
Oh, absolutely. And I'm still trying to get a good deal. And the thing is, I think, my husband and I have talked about this. He's less frugal than I am. Growing up poor, I'm very, very frugal. But both of us, we don't want to leave very much to our children. And so we want, when we got together, we said if we ever did have money, we wanted to donate it and better the world with philanthropy. And so I feel like I'm frugal so I can save more money to donate.
Yes. So as much as you're comfortable sharing here, Jennifer, and I know we touched on this a little bit at the beginning, how did this 100 million come to be?
Sure. So 6 years ago, I mentioned I bought my first rental property, my first home. And at that point, I had been a massive saver. My first job out of college was $55,000 a year. The highest I've ever been paid has been $150,000, but I saved almost all of that. I lived in apartments that were, I remember one of my apartments was $412 a month. So I saved almost all the money I could. About 6 years ago, I think my personal net worth was about $1 million then. And that was through investments and savings. And then about 5 years ago, we bought our second rental property, and I had a liquidation event from one of my companies. Actually, I had a small liquidation event 6 years ago, but 5 years ago, I had a larger liquidation event. And 3 years ago, another liquidation event from another company. Between my husband and me, we've been in 3 companies that have had liquidation events. So 3 years ago, we had another liquidation event, and that took our net worth up to about $5 million. In 2019, we moved back home. I'm from Texas. We moved back to Texas, had another liquidation event that took us over 10 million at that point. And then this year, we had another liquidation event, which has taken our net worth higher than that.
And these are all companies that you've started, correct?
2 of them I've started, and one of them, my husband was an early employee yet.
And so have you always been an entrepreneur?
I am a former consultant and former operator. So I haven't always been an entrepreneur, although one of my friends from high school tells me that she remembers we were in nerd camp together. She remembers that I used to buy a bag of Dove chocolates from CVS, and then I would go around and sell them for 50 cents each and make a profit that way from our nerd camp nights because, nobody had food then. So I would sell the Dove chocolates. So she says I was an entrepreneur then, but I don't remember doing that. So I do remember trying to kind of follow a traditional path. I had many, many jobs.
So Jennifer, it sounds like you're busy, right? Obviously, you're married, you have a family as well, you have these businesses. Now you're trying to figure out how to allocate this money. You're involved in the businesses that you sold, but you'll probably, I assume, want to start another, or maybe not. Maybe you also have the laundromat, car wash, all these different investments, the private equity stuff, the angel investing. How do you decide who gets your time?
That's a great question. Well, first of all, we work with a financial planner who is a high net worth individual herself, and she actually brings a lot of investment opportunities to us. And she does a lot of the due diligence because that's what she loves to do. The second thing is I have an assistant who's excellent. So I'm in another startup, another high growth startup that I started a few years ago, and she's my assistant there as well as my assistant in life. And so she does quite a lot of research on different areas for us as well.
So she helps around in all aspects.
Oh, absolutely. Yeah, she helps with family life, all sorts of logistics. And so that frees up quite a lot of time.
And when did you feel like it made sense to hire somebody like that?
Well, I have to say she's not full time. So we have been working on 20 hours per month basis on $25. It was when there was that company called Zirtual that you may remember from, I don't know, probably 5 to 7 years ago that started, and it sounded like a great idea, which is kind of fractional assistant sharing. And so I just signed up for it then, paid probably $200 a month for 8 hours a month, I think is what I started with. And from there, I realized, how it can really free up time. Because frankly, I'm not very good at administrative things, and it took my Zirtual at the time a whole lot less time. In 8 hours, she did as much as I could probably do in 20. So it freed up, call it 20 hours of my time. So that's when I realized it was something really worth it.
Yeah. And how many hours a week do you work now?
In my full-time job, which is the company I started, I work, I would say, probably 45 to 50 hours a week.
Gotcha. And then obviously you have the family.
I would like to work. Yeah, I would like to work 60 or 70 hours a week, but it's very hard with a family.
Yeah.
So
and has it always been that way?
Go. Yeah, I just have to let some things go.
Yeah. And has it always been that way for you? You've always worked that much, or more because it's just your company now?
Yeah, no, I've always worked really hard. Growing up poor, I just saw working hard as a way to get ahead. And since then, what's crystallized in my head has been the three things that matter in doing well financially. I would say is smarts, drive, and access. So those three things. And if you have two of them, you have a very high chance of doing well financially. And then if you have three of them, you have an even higher chance, but you just need two of the three. And so I had that semblance of a thought growing up. And so drive I see as working hard. And so I remember I would work 80, 90 hours a week. One time I clocked in, 130 hours a week, and there are only 168 hours in a week. Whoa. But yeah, I remember one very bad week I worked 130 hours in a job that I had.
Jennifer, do you mind elaborating on those a little bit? What does access mean? And maybe elaborate a little bit on smarts as well.
Sure. I think what access means is access to the right networks of people to ask questions and get advice, as well as have access to, like if you're starting a business, access to capital. So kind of being in the right networks to have access to information and knowledge and or capital that you may need. So resources. So access to resources is what I mean by access. And then by smarts, this could be one of two ways. And a bunch of my friends have done very well. And so they're either just incredibly like book smart, right? So they're really, really good at math and kind of can compute a lot of things in trading strategies. Or they're very street smart and can work with people to get things done, or kind of figure out how to, say, make a company work, or how to grow a business that they're in even bigger and get rewarded for it. So I think that's what I mean by smarts.
Awesome. So as you look towards the future here, is there something, I know you mentioned philanthropy and a couple other things. Do you feel like you're still on the upward trajectory? Is it the accumulation phase in your net worth and your financial journey, or are you more to that preservation phase at this point?
What a good question. I think I would say probably a third of what we have, we're probably talking about preservation. And then the other 2/3, we're talking about growth. So we're finding opportunities to grow it even more. We are holding off on philanthropy unless it's a tax advantage at this point, because we have a young family. We also don't know where life is going. And we also don't know where our philanthropic interests are in terms of where our assets could make the largest impact. And frankly, we don't even know what impact means to us yet.
So as you look at the 2/3 in accumulation phase, still a good chunk obviously is either going to be in private businesses or it seems like you've got your allocation pretty well set. What kind of return do you look for, and what do you look for in an investment opportunity?
That is a good question. I think it depends on the asset class, right? So cryptocurrency, for instance, it could go to nothing, and we're okay with that, and the return would be negative. But at the same time, cryptocurrency could go really high. It could be, over 1,000%. So that's kind of a wild card. If we look at real estate, which is kind of the most tried and true asset class other than public equities that we have two types of real estate investments. One is the kind of general multifamily investments that we have done. And the IRR for those, and this is with a LP GP structure where you just put your money and you don't have to do anything. For those, we look for an IRR of, 18% or north of 18%. And we're doing better in some niche areas of that real estate class. For instance, military housing, we're getting much better IRRs on. And then the other real estate class that we have invested in are more debt instruments. So these range from, we have, for instance, a fund that we have put a big chunk of money where we're getting 10% per year, and we get a deposit in our bank account every month. And that's a 5-year window. And then at the end, we get our principal back. There is risk, but not too much, which is why the return is only 10%. And at the same time, we have other kind of debt instrument real estate investments that annualize to 40% a year. But they're in 6-month chunks, and there's risk involved. In, for instance, one of them is a Brooklyn renovation. And we're probably going to do one in the Bronx as well of New York. And if the houses don't sell for what the developer thinks the houses will sell for, then we may lose a lot of money. So it ranges from 10% on low risk to 40% or more on some of the higher risk ones that we're trying out.
For some of these investments, maybe particularly in the real estate, what do you usually what's your comfort level in terms of writing that check? Is it, hey, I'm just going to, put a 6-figure sum in these and that's going to be it? I don't want any capital calls. Or is it more, hey, you know what, I'm willing to probably ride this ship with this particular investment for as long as I need to?
Mm-hmm. Well, we try to keep our family's spending amount fairly low. So we don't really need any of the investments to pay our day-to-day, right? We could probably get by on my salary. And I don't make that much, but my salary and maybe 1 or 2 small investments would probably pay for our family's living costs. And so we're not really looking for any of these investments to be supporting our lifestyle. So what we like to do on the real estate things is, as we meet new people, we'll sort of like toe in the water a little bit with between 50 and 200,000, and kind of work together over a course of a few months, half a year, whatever the sort of project span might be, to get to some milestones and then put more in after that.
Over the last 7 years, going back to when you mentioned that you were basically broke and had nothing, to where you are now, at what point did you feel comfortable increasing your lifestyle and spending? Because obviously you weren't spending then what you probably are now. How has that journey evolved?
Well, to be honest, it's still evolving. I'm not comfortable spending very much still. And I think if you look at the one area we spend on is travel for the experiences, right? And I'm borderline millennial, so very much about experiences. And so this year we have started to loosen up on spending in travel. Even then, though, I'm looking for 50% off deals. So I think we're starting to this year. This year we have looked at buying an airplane, but even then we're looking at an Airbnb model, which is what's the break-even point of renting out this aircraft so that we can cash flow positive on it.
Interesting. The loans that you mentioned, the real estate loans, are those always collateralized by something?
They are usually collateralized by the real estate asset, yes. But the real estate asset, like the military housing, for instance, the unit are bought, like the house that would be a teardown is bought for, say, $20,000 or $30,000. And then you have to put a lot more money in to renovate it. So yes, it's collateralized, but kind of nobody wants that asset.
Right.
So yes, that's why I hesitate. Yes and no. They're usually collateralized by the asset. However, some of the other investments, for instance, VC funds, hedge funds, are not collateralized at all. And you had asked about capital calls. One thing that I've since learned is on VC investments or some fund investments, it's a capital call over, say, 3 years or 4 years. So you don't actually have to have all the money now. You just have to have it committed.
So take out the businesses that you guys have built and your husband was an early employee at. What have been your top 2 investments, and tell us about a bad investment you've made?
Let's see. Top 2 investments. I would say, just on a percentage gain basis, was an apartment that my mom and I did together. She bought for $36,000, and that included a parking spot, which is incredible. And then the owner, this complex that it was in, was 80 to 90% owned by a same owner who wanted to own 100% of the units. So went around, dissolved the HOA, and forced a sale, except fortunately we have a good real estate attorney who pointed out a couple technical things he was doing wrong and which would hold up the big process. So I let him know that I did a comp analysis of the market and found that it wasn't right what he was offering us. And so I asked for $130,000. This is a $36,000. We did put money into it in terms of renovating it. And then he was trying to force a sale for $80,000. I told him, no, I have comps for that get us to $130,000. Wouldn't budge on that, and we eventually had the sale. So on a percentage basis, that's probably one of the better ones. And then I can think in absolute dollar ones if helpful. But so that's an example of one that's done well. We've had mistakes as well. So many mistakes. We've done some angel investing in early stage startups, and I would estimate we've probably put in about $300,000 into different angel investments and gotten, I think we'd be lucky if we get 20% back. So that's a loss.
That's still pretty good though, even if, 20% of your initial, not a 20% return.
Yes. We've lost 80% of that. And then I have different individual stocks that I've invested in and have basically lost all of it as well. Now we do not invest in early stage startups and I don't invest in individual stocks. My husband's a much better individual stock picker than I am.
And do you do index funds?
Yes. So half of our public equities are in index funds. And then the other half are in things like the FANG stocks, the Facebook, Amazon, Netflix, Google. We put in NVIDIA in there sometimes as an extra N as well. NVIDIA is the graphic chip company. So we do FANG stocks and index funds.
Yeah. So Jennifer, just big picture here. So net worth of $100 million, you've got 80% of that tied up in the one company stock that you're bullish on, you mentioned, right? So that leaves you $20 million. If you start doing a lot of $50,000 or $100,000 or $200,000 investments, even $500,000 investments, it becomes a lot to keep track of.
You're absolutely right. And it's not only to keep track of where they're going, but also collecting the K-1s and 1099s to do your taxes. It's quite a lot of work.
Yeah, exactly. All that. And then you're trying to manage it. You're trying to oversee it. You're working with the different operators. You're a limited partner. You're a general partner. I mean, you got all these different pieces moving on. So how do you decide, hey, this is worthy of, you told Jace it was 50 to 200,000-ish to kind of date before you get married. Mm-hmm. How do you decide who that money goes to initially?
We have not come up with a very good strategy, which is why I listen to your podcast to get ideas. So we have recently talked about a minimum check size of $250 just to make it more manageable, because the way we've done it is probably a mistake in terms of the many, many different little investments that we do. And so we're thinking about a check size of $250. However, we still want the dating phase. And then the question is, how do we vet that? And we'll do a couple calls and then check the numbers. We want to look to see if there's anything off about it, because there are a lot of people who will tell you an investment is very, very good, but just the numbers don't match up. And then some backdoor due diligence calls will tell you that, say, that market is not good, or it's incredible. Sometimes you do due diligence calls on people, backdoor ones, never references that they give, and you'll find out some skeletons in the closet. So how do we find who to date? We do a couple calls, make sure the numbers are correct, and then also the people are straight.
Yeah, good approach overall. So let's shift gears here and talk about asset protection. And we have a listener question here we're going to play.
Hi, I am a new listener. I've listened to 5 of your podcasts so far, and I have a question that I have not heard addressed yet. That is, how do millionaires protect their assets? So an example is I have an investment account that is taxable, and I moved it into an LLC to protect it from creditors in case my insurance doesn't cover a claim against me. But I would like to know how other millionaires are handling this same issue. Thank you.
Yeah, so I think of this in 4 parts. One is, how do you protect against liabilities? The second is, how do you protect against taxes? The third is, how do you protect your investment returns? And then the fourth is, how do you protect kind of the overall amount that you have? So in terms of the first one, which is how do you protect against liabilities? For anything that we might have risk exposure on, for instance, car wash, laundromat, huge risk exposure, even rental properties, a slip and fall and a lawsuit is risk exposure. We have created some LLCs that you shelter assets in. We do not ever name the LLCs after anybody in our family. We always give them names that you couldn't tie back to us. Also, because the LLCs get, you have a lot of them after a while, we've learned that you can do what's called a series LLC. And so any attorney, our real estate attorney does this for us, where we create one LLC, one name, and then within it, we have Series 1, Series 2, Series 3 that we can then shelter assets in each one of them. That's protected. So in terms of liability protection, we mostly work with sheltering in LLCs. We also have a general liability line just in case. We calculated what the risk of lawsuits are, and that's, of the people who stay in our Airbnbs, what could their income loss potential be, and then try to protect with a general liability line. The second, in terms of protecting from taxes, that's a great question. Just as a side note, we would invest more in hedge funds. The hedge fund returns are amazing. They've been 25 to 40% plus per quarter. We would invest more in hedge funds, except for any gains in the hedge fund, we have to pay taxes as we go. And so you have to be much more, liquid in cash to be doing that. So that's just a side note. Protecting on taxes, we are exploring and probably will invest in an instrument called a PPLI, Private Placement Life Insurance. And just like you have a life insurance policy, if it ever pays out, that's tax-free. When you're lucky enough to be able to put, a big chunk of it in a life insurance instrument, you can actually have a third-party manager trade it for you. So it's not like a life insurance company with really low returns, but you can get better returns and shield those returns from taxes. And then the third way that we've been exploring in terms of shielding from taxes are opportunity zone investments. So we haven't made any opportunity zone investments, but we've come close. And one of the reasons is that we'd like to learn about the tax benefits of investing in those. The third, which is protecting investment returns, because when you read about investing, it's all about kind of that return rate, right? The way we protect against that, and we're trying to figure out our ideal strategy, is diversification. So having an allocation strategy that is very diversified, where you don't have correlations between the asset classes, that if one asset class moves up, the other one could move down, right? Or vice versa. So we're trying to get asset classes that aren't so highly correlated. And then the fourth one, which is protecting against the overall amount. That one we haven't quite figured out. I would say what at least I try to do is stay frugal and not spend beyond our means in terms of I have a salary. Right now, it's not that big. And then we have some investments that are pretty steady in returns, and we just live off that. So we don't have to worry about our overall amount. I know that may sound silly, but that's, I think, gives peace of mind, at least to me.
No, it's really interesting overall. Thank you for sharing all that. And then when you're coming up with these LLCs and you have the series LLCs and different investments within each of them, is there a certain cap in terms of value that you put on each one? Just so that if something were to happen, it doesn't totally destroy you. You just, you're capped out at a certain amount of value in each LLC.
We haven't hit that problem yet. And in fact, we're probably investing directly in rentals and, car wash, laundromat kind of operating businesses less. And we're actually divesting of those. So we sold the car wash and laundromat, as I mentioned a few months ago. We're selling one of the rental properties, and then my friend and I, who own the other one, we had agreed to sell it when our kids go to college to fund their college. But since that's sort of not needed on either of we may actually sell that as well. And then so not have that liability risk exposure at all.
And why are you selling? Is it because of that liability risk, or because you feel like it takes too long to manage, or because you can find better returns?
All of the above. We are spending quite a lot of time as property managers, messaging with guests and tenants and handymen and things like that, doing that a lot ourselves. It's also not as good returns. Our cap rate on these properties aren't great. Our cash flow as a percentage of cash invested isn't as good as some of these other asset classes and other investment opportunities that we have. And so my friend and I are still in it because it allows us time to talk, right? We talk every month now because we have all sorts of tenant and guest issues. So we talk. And we're friends, and it forces us to talk. Otherwise, we probably wouldn't talk for a year or two at a time.
Interesting. So, Jennifer, one thing that we touched on a little bit earlier that I want to come back to is just how you think about that next generation in lessons and wealth and what you plan to do with your family and your giving and everything that y'all will be taking into, the next couple decades here.
Yeah, my husband and I talk about this quite a lot, and we have both agreed that we don't want to, we're very much of the Warren Buffett approach, which is we want to leave enough for them to, say, buy a house and maybe something else, but not enough that they can do nothing. And so we're not actually going to be talking about the various trusts and the amounts of money we have with our kids. They won't know that they have any trusts. In fact, our financial advisor, her son has a very, very large trust that he doesn't know about until he turns a certain age. For our kids, we had set the age at 35. So we fully expect them to go get an education, go get a job. I've helped one of my children start a business so that she can make more money. And then every time she wants me to buy her something, I say, well, we need money for that. How are you going to find that money? And she says, oh, we need to go sell more things in my business now. So we're trying as much as we can not to think of passing this on to generation, the kind of bountiful blessings that we have. We're not passing on to other generations, but instead setting them up to be successful themselves.
How do you go about education for your children? Are you sending them to private schools? Are you going to pay for that? How so, if you are?
Yeah, no, we're doing public schools. And in terms of high school, we are thinking maybe private school, perhaps boarding school, and then colleges we'll probably pay for college. Both my husband and I had parents where the gift to us in terms of adulthood was helping us pay for college. Grad school, I didn't take on loans for, but kind of got loans from other sources. But college, my parents scraped and I got scholarships to pay for college, so we didn't have loans. So we would like to gift that to our children as well.
And you'll tell your children that?
In terms of,
paying for their schooling and whatnot?
I don't think so. We'll cross that bridge once they get into a college that they like and that we agree on.
When you get together with friends or family, do you discuss wealth, money, investing strategies?
What a good question. I think the answer is it depends. So I did go to business school. So with my business school classmates, we do talk about money because that's kind of the currency of business school, right? And investing and, what you're doing with your money. With some of my friends who are entrepreneurial as well, yes, we talk about that, especially in light of our startups and our startups not being liquid is often the context for that. And then with other friends, so from college, I went to a liberal arts college. No, we don't really talk about that. Instead, we talk about, what we're curious about and we're trying to learn about. So no, we don't talk about. So I think it depends. With family, my parents tend to be very nosy. And so we don't actively talk about we don't talk about money or wealth with my parents.
All right. Well, I know we're getting tight on time here, Jennifer, but I just want to talk about a couple things we talked about before we started recording. One of those, you wrote in because you wanted to share a positive message to women, right? That you can be successful in tech and how that's had an influence on you. So I just wanted to give you a chance to share your thoughts on that topic.
Yeah, thank you. Yeah, I wrote in because you had a call out for more women. And so there are two things that kind of looking back on the last 10 or 20 years that I've done, which I think has served me well. And those two things are, number one, ask for what you think you're worth. A lot of women, and I certainly was like this, wouldn't and would just kind of take what I was given. But once I started asking for what, I didn't know what I was worth, but someone had given me the advice, just ask for more. So I just asked for more. So I just asked for as much as I could get. And usually people gave it to me, which is crazy. A book comes to mind that is a good read here, which is a book by Cal Newport called So Good They Can't Ignore You. And he talks about how you can build up your capital, your personal capital, so that you can charge whatever you want for what you're worth and then have financial freedom and then love what you're doing as well. And so two stories come to mind in terms of when I tried this and had the light bulb moment, oh gosh, I should do more of this. So one comes to mind, which is after grad school, I got a job offer in healthcare for a private company, and they offered me $90,000. And my classmates were getting offers for more than that. So I asked for $125,000 and a $25,000 bonus based on performance. And we kind of went back and forth. And I said, well, frankly, I have other opportunities. If my classmates are getting these offers, I can probably go get those too. And bam, they made it happen. So I said, wow, okay, someone had told me women under negotiate their salaries or don't negotiate at all. And so I took that in mind and I just asked for what I thought was a lot and I got it. Another story comes to mind, which is in my first startup, my co-founder and I were talking and he offered me 1% equity. And I said, I don't think so. That doesn't sound like a co-founder to me. And we settled on, and he had already kind of done some beta testing and things with the technology. And so we settled on that I would get 2/3 what he had, just so that we could account for some of his time spent up front. I asked for that and he said no. And then I said, great. I mean, I can go do other things. And, there are all sorts of other opportunities. And then he said, oh, no, let's do that. So got that. So it went from 1% to over 10% on a fully diluted basis.
For you. Good.
So that's the first thing that I learned, which is ask for what you're worth. And if you don't know what you're worth, just ask for an egregiously large amount and see if you can get it. The second thing that I've learned over the last decade or so is start a business. And if you have drive, smart, drive, and access. If you have drive, start a business and don't start a business that is, just kind of passes time if you don't want to. If you want to, that's great. But if you want to start a business and grow it, you should do it. And then you should do it in technology and not consulting and not research. And the reason is because a consulting firm valuation is 1, maybe 2 times revenues. Mostly it's on an EBITDA basis, right? Like a multiple of EBITDA. So with consulting, it's 1 times revenue. If you're lucky, maybe 2 times revenue. Tech businesses right now are trading or private ones are selling for 5x revenues. The public ones are trading at 20 to 30x revenues. So if you start a business and you want to grow it, start it in tech. And the reason I often hear from women that I talk to, whether it's friends or potential mentees, is, oh, I don't know tech. And you know what? I don't either. I wish I coded. I wish I had learned programming, but I don't. But you can talk the talk. You'll learn it. Don't worry about it. You can hire people to do that. So if you want to start a business, you have drive, and then you have either access or smarts, hopefully both. Start a business in an area that you get a good valuation and a good multiple in. So those are the two things that I have learned that often women don't do, that I've sort of played around with and tried doing, and found that it's worked really well, at least for me personally.
Awesome. Well, thanks for sharing, Jennifer. What great advice for anyone, male or female, right? So we'll end it there. Thank you so much, really, everybody.
Thank
again,
you both
Jennifer
for this
Networth
podcast. I really love
of
your
100
podcast.
million. Well, thanks for coming on. We're appreciative to you for giving us more than an hour of your time here. So thank you.
Thank you.
Thanks, Jennifer.
Thanks for listening to the Millionaires Unveiled podcast with Clark Sheffield and Chase Mattinson. For more stories, investment opportunities, and information, check out our website at millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.